Welcome back to the Sense of Security podcast. I'm Cassidy Clement, Senior Manager of SEO and Content at Interactive Brokers, and today I'm your host for the podcast. Our guest is Robert Crothers, Managing Director and Head of U.S. Retirement at BlackRock. Target date funds look to rebalance over time without interaction. This offers an almost autopilot experience to the investor. This may be viewed as a conservative option. There are still advantages and disadvantages to utilizing them in your financial strategies. Welcome to the program, Robert.
Thanks, Cassidy. Great to be here.
Yeah, so since this is your first episode, why don't you tell the listeners a little bit about your background in the industry?
Sure. As you mentioned, I'm head of retirement at BlackRock. That generally for BlackRock means our defined contribution business, but I deal with lots of retirement problems in the US and in other places. Spent about 25 years in the industry, all of it at BlackRock, and done a variety of different things, either in the US wealth market or working with individual investors, or prior to joining retirement with institutional investors globally.
Yeah, that's great. So you seem to be the right person for this episode. So we're going to talk about target date funds today. So just to lay the groundwork, what exactly is a target date fund and how do they work?
Great question. In part because target date funds, I think, are somewhat poorly understood. You gave a pretty good explanation in your intro, but a target date fund is a professionally managed asset allocation portfolio that shifts its asset allocation over time to become more conservative or introduce new asset classes. In the case of target date funds, they're traditionally used for, or most often talked about, for retirement investors. And the reason they're called target date funds is, generally speaking, the funds themselves have a year or a date within their name. More often than not, that date corresponds to some sort of a savings related target. Say, for example, when I intend to retire, or in the case of a birth year based fund, the year in which I turn 65. When I mention professionally managed and shifting asset allocation, generally speaking, what that means is that the risk that the funds take changes over time. So starting with, for example, more growth orientated assets, maybe, for example, a higher weighting to equities over individual bonds, and then shifting that allocation to introduce more bonds over time, or to, for example, introduce things like inflation sensitive asset classes as the portfolio gets more conservative as you get closer and closer to your target date. So think of it as a sort of one-stop shop for asset allocation that dynamically adjusts over time such that individuals can invest and over the course of their investing life, shift allocations to become more conservative.
Yeah, they usually tend to be referenced a lot with retirement and changes within the market towards a retirement date, as you mentioned, inflation. But can they really be invested in for other purposes, or is the main goal a retirement vehicle?
Absolutely can be used for lots of different purposes. What we traditionally talk about when we talk about target date funds is what we call a glide path. And that's the change in asset allocation over time towards a target date. Glide path type asset allocation funds are used in lots of circumstances. We call that goals-based investing more often than not. For example, it can be used and is used widely in educational savings. For example, I know 18 years after birth, ideally I'm sending a child off to college. It's used often underneath, for example, Section 529 or educational savings plans. So can be used in a sense for any sort of savings goal that has a kind of fixed certain date or has an approximate time period in which you'd want to take action. I would say one thing that we didn't talk about at the beginning, but I think is important, is once you hit the date in a fund, it's not like the fund goes away. There are two different approaches to how target date funds traditionally work. In some cases, they continue to de-risk post that date and continue to take less and less equity risk. For example, as you've reached your savings milestone, we call that a through approach because it's through the target date. In other cases, the allocation at that point becomes fixed and you move towards a sort of fixed allocation portfolio, say maybe 40% equities, 60% fixed income. So think about target date funds. Yes, 100% predominantly used in the retirement world. 95% of all 401k plans use target date funds as their default investments today because of their ease and simplicity in implementing a savings goal. But think about it also as a tool that can be used outside of a DC plan or outside of a 401k, really for any savings goal, whether that's supplemental retirement savings or, like I mentioned before, educational savings, buying a house some point in the future, something that you want to become more certain of in your allocation or exposure to investments, the closer you get to that target.
So you mentioned a little bit about the makeup of the fund when you get closer to the set date, but how exactly does the fund ebb and flow when you're closer to the end versus further away to the end date? Is it more based on the risk associated? Is it impacted a lot by the external economic factors, or is it a little bit more like dollar cost averaging where it's slow and steady towards the allocation?
So the answer is a bit of all of the above. And I say that in part because target date funds come in lots of flavors. There are some that are index implementation that are much more sort of asset allocation driven. And we'll talk about that in a second. It's a good example of what you're talking about. And there are others that are more actively managed that, for example, might tactically manage during a specific market for its individual exposures. The broad form, think about target date funds as shifting asset allocation strategically over time. So I mentioned that glide path context. Just walk with me here as an example. Say for an average in the retirement context, an average 20 or 21-year-old starting in the workforce, he or she may have, call it a 95% exposure to equities. They have the longest investment time horizon, so can take the most amount of investment risk up to the point of retirement that's, say, 4 years or so away. 5% maybe in fixed income, or perhaps as much as even 99% equities, 1% fixed income. That then, I'd say, structurally or strategically changes its composition over time. Target date funds typically rebalance periodically within a year, so reallocate their assets within stocks and bonds or other asset classes, whether that's quarterly, whether that's monthly, or as individuals contribute more money to the dollar cost averaging point. But the crux of the construct of a target date fund is that the allocation doesn't stay fixed. So maybe in year 26 or age 26 or in age 30, you'll see within your target date fund that instead of at 95% or 99% equities, maybe I now own 90% equities as it's taking more fixed income risk or bond risk and less equity risk. The purpose of this is to use long-term, what I would call capital market assumptions, as well as an understanding of what drives human savings behavior, what we call human capital in terms of an investor's working life cycle in the retirement construct. It's a bit different in retirement, in education savings and other places, to build an optimal strategic allocation that allows investors to take what we would deem appropriate amount of risk wherever they are within their investing life cycle. So again, to my point earlier, individuals who are age 20, age 25, long time horizon to retirement, can take the most amount of risk at that point. Well, you don't want age 60 individuals taking that same amount of risk, all else equal, unless they purposefully elect to do so. In that case, you're much more, call it 50% bonds, 50% equities, or even 40% equities, 60% bonds. So think about the asset allocation shift as mostly kind of strategic in nature, long-term capital markets driven, not necessarily tactically managed, and more model-based in the way I would describe it. If I buy a target date fund today and you buy the same age vintage of a target date fund today, we get the same exposure and we'll have the same kind of glide down the glide path, all else equal.
You had mentioned the details that would go into why a lot of listeners or investors look to target date funds as it's the conservative autopilot option. We mentioned this a little bit in the intro because it is long-term and model-based. You're setting it and watching it as it moves towards that date that you are looking to be a part of or potentially sell at. But what are some things to keep in mind if listeners are looking to incorporate target date funds into their financial strategy? Because really at the end, you're looking to get some type of a return to utilize for a goal that, you desire to reach, but there's obviously good and bad risk and reward associated with all investments.
Totally with you, Cassidy. What I would say a target date fund is, at its heart, is a do-it-for-me investment. Right? I buy a target date fund when I'm young. I buy a vintage, for example, or an age that corresponds to when I expect to retire. Let's just say age 65. And then it's going to continue to take the appropriate amount of risk in the manager's determination over that time up to the point of the target. Things to keep in mind, do it for me works for some, but not all. And it doesn't necessarily have to be all of your savings. Many folks use target date funds as a core, for example, of their savings that will do it for them. And then they invest other capital, whether it's supplemental capital in their retirement plan or outside of the retirement plan, or other capital that they have to invest in a different way, for example. It can be your entire savings if you want it to be, but it doesn't necessarily need to. The thing that do it for me creates is really two behavioral challenges. The first is a lack of an explicit need to engage with your money. So one thing I would caution all investors to do is to continue to stay engaged. That doesn't mean checking your balance every day. It's going to move every day with the market, et cetera, so on and so forth. But continue to stay engaged so you understand not just what your investments are doing, but for example, what it might be able to deliver for you. Because the ultimate goal in a target date fund or retirement savings is to take in and create more savers, to take savers and make them investors. And target date funds do that in a very efficient way. And then take investors and enable them to live the retirement that they want as spenders, for lack of a better way to put it. I think maintaining focus on what your goals are and what your objectives are, what your risk tolerance is, are important, because target date funds are actually quite flexible. So for example, I mentioned in a career context or a working life context, someone at age 20 has the longest life cycle or longest working life. They could take the most amount of risk. That may not be suitable for them in their minds. They may not want to take 95 or 99% equity risk. And as a consequence, they can buy a fund in a target date fund series that has an earlier date. For example, that may be the one that is prescribed for, generally intended for those that are 20. So being purposeful for what your goal is and understanding what your risk tolerance might be, I think allows you to use target date funds much more effectively. The other thing I'd add is set it and forget it, to use your words, or autopilot. Also, sometimes in creating a lack of a need to engage, limits the effectiveness of continual contribution. Again, the investments will deliver whatever they deliver. The power of capital markets is in compounding and dollar cost averaging. And you see this a lot in retirement, where every 2 weeks, you're putting money into your 401k, or if you don't have a 401k, into your IRA, or think about the power of compounding in a target date fund context is going to be driving most of the investment return, even if it is a set it and forget it like strategy, because you're buying in at different times, different cycles over the course of your time. So don't let the idea of set it and forget it, or one size fits all, or most, or building the best product for the most amount of people dissuade you from either engaging with your money, understanding what your goals are and making sure that you're invested in the right place, or continuing to save as much as you can. Because the primary determinant of whether you reach your goal or not is going to be whether or not you've saved enough money, not whether markets have done what you want them to.
A lot of people look towards target date funds with the pros of the rebalancing aspect, the diversification, easy enrollment's another pro, especially when you're looking at it from a retirement perspective, if you're looking to utilize a type of retirement plan within your workplace. But some may say that there's elements of it, the funds being maybe too conservative when you start to enter that area, because it can be an information overload. Sometimes there's a lot to select from. But what about the fees aspect and the orientation towards finding funds that are more associated with your actual goal? Are there ways to research for better fees, less conservative or more conservative investments?
There are, Cassidy. So I mentioned earlier that target date funds aren't homogeneous, aren't one size fits all. They come in different flavors. There are some that are index based, that rely only on tracking indexes. They tend to be lower cost, and they tend to be offered by a variety of providers that traditionally might have index based investment strategies. There are others that are investing in active based strategies, tend to be a little bit higher cost, but they seek to outperform the indexes by introducing active management into the target date fund or into the underlying building block funds. Variety of different ways, whether it's through third-party investment research, say work like a Morningstar, Yahoo Finance, or actually just engaging with fund companies themselves. They're going to most often, in that case, tell you about what they do. But I will say that most or many target date fund managers offer a variety of target date funds. We, for example, offer a handful of different series that do it a bit differently so that they can offer choice to their clients. Some, for example, that want an index-based implementation, lower cost, maybe a bit more certainty of outcome versus an active implementation that seeks the opportunity to add incremental performance, which can make that compounding effect I described earlier a bit more meaningful.
Yeah, those are great points. Thanks so much for joining us today, Robert.
Happy to be here. Appreciate you having me.
Yeah, of course. So, as always, listeners can learn more about an array of financial topics for free at interactivebrokers.com/campus. Follow us on your favorite podcast network and feel free to leave us a rating or review. Thanks for listening, everyone.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.